The global trade war intensified this morning with China retaliating on the U.S. with 34% tariffs. This trade war seems like it's intensifying and it's causing a lot of risk in the market. Yesterday, the market had its worst drop since 2020, wiping $3 trillion off of value. And with these retaliatory tariffs from China, it looks like the stock market's going to have another bad day today, wiping probably close to that amount again of value up the stock market. Right now, there's a lot of fear right now based on these tariffs. Could there be more retaliations? There's a lot of uncertainty right now. Jeremy Siegel, Wharton School of Business professor, thinks this is the biggest policy mistake in 95 years. Although we want manufacturing back in the U.S., that's certainly true. The way we're going about it isn't necessarily good. It's causing a lot of uncertainty in the business community and it's pulling back consumer sentiment. And we might cause a recession and, we're risking stagflation. Look, we could see some long-term gains from these, tariffs bringing money into the U.S., bringing manufacturing, to the U.S. as well. We're already seeing about $5 trillion of companies investing in the U.S. And if we raise revenue from these tariffs, that's a silver lining. However, in the meantime, it could cause as I said, a recession or a stagflation. And, these long run benefits, if this happens, well, in the long run, we're all dead. So in the short term, if this does cause a recession, that would be very negative, obviously, for the economy. So it looks like Trump was saying, and the White House was saying that they are open to negotiations. Last night on Air Force One, Trump was saying that if there's something phenomenal, that contradicted what he said yesterday. So you're seeing a lot of contradictions. So that's not really helping the situation. And then obviously the jobs and unemployment report came out for March. That came out better than expected at 228,000 jobs. So that helped the stock market futures in the morning a little bit. The markets were down more, and this helped it a little bit. And the unemployment rate ticked up to 4.2%. But right now, the trade war is overshadowing this jobs and unemployment report figure, the fact that these job gains were more than expected. And then on the contrary, yesterday, the Challenger Grain Christmas layoff report showed that, the DOGE cuts, the government cuts are really leading to the highest layoffs since 2020 as well. So I think there's a lot of uncertainty right now. It's self-inflicted. A lot of this could be done if we, not necessarily come to the table, but work with other countries and try to come to a deal. But right now it looks like things aren't great. And, there's so much uncertainty out there. And hopefully we could come to some sort of agreements with these countries. That's why I think the first half of this year is going to be very, very volatile. I might even have to increase my chances of recession of 50% right now. Look, if we have a recession, I think it'll be shallow. I think the government would start printing money and also cut interest rates to near zero if that happens, from the old playbooks from COVID and, the 2008 financial crisis. But however, because of all this uncertainty, I think I might have to even revise down my year-end target. I already revised it down once to 6,400. I think it was initially 6,600. I'm going to revise it down now to 6,000. Look, it could certainly go higher than that, but with all this uncertainty right now, and I'm seeing how the market's behaving the last week or so, there's a huge wall of worry, and I think we're almost at a 50% chance recession odds. And yeah, there's going to be a lot of volatility this first half as other countries are in the negotiation phase with the White House. So that's going to take a while, but I think by the second half of the year, there should be more clarity, and there should hopefully, if things get bad enough, then the Fed could come to the rescue based on their experience playbook and start pumping money again and cutting interest rates. So they'll probably be more careful this time because they don't want to cause the inflation that happened after COVID. So let's stay tuned. I'm still bullish. Obviously, once we get through the next few months, I still think that we're in a good 2 to 4 year bull market for tech. I expect a bad bubble burst, obviously, at the end of the decade, once there's the euphoria with AI and stuff like that really settles in. But until then, I expect some really strong performance in the economy, at least once after we get through this little short-term hiccup phase. And then look, I mean, another thing I wanted to say about the negativity of these tariffs is it's going to obviously raise prices to the consumers, especially for technology. Dan Ives and Webbush is saying that, by jiggling the supply chains, it could cause iPhones that currently are predominantly made in Asia to go from 1,000 to 3,500, if we make it in the U.S. So things will get more expensive. And look, tech's supposed to be a deflationary force. And that's really the bull case for technology companies, technology stocks. But if we start seeing technology prices increase a lot, that might put that bull case and that thesis into question. So I'm a little bit, I'm a little nervous right now, to be honest. So obviously we have to see what happens. Jerome Powell has a speech in another hour, standard economic speech. I'll make another video if he says something that's interesting that could move markets. But for now, let's hope this tariff talk doesn't get worse. I still think ultimately we're at the worst end of this. You already had the higher than expected, worse than feared tariffs that Trump announced, and then China's retaliatory tariffs. China is one of our biggest trading partners, so they have a little bit more leverage to do that. But I don't really expect another power player to do the same unless we really go tit for tat with China. Obviously, we have the TikTok negotiation, the buyers of TikTok negotiating with China. Could that lower tariffs on them? Obviously, we'll see. So that'll be a news story. But for right now, there's, hopefully other countries don't retaliate. But China, if any other country, has the biggest cards to do so. But hopefully, China and the U.S. start talking and reaching a negotiation settlement and could hopefully bring tariffs down. But either way, although Trump's the end goals are decent in terms of bringing manufacturing back to the U.S. and raising some revenue from tariffs. I don't like the uncertainty of these policies, and I don't like the way and how he's going about it and the arbitrary nature of it. So, and the market's sniffing that out too. So hopefully we avoid recession. I expect, right now it's 50-50 chance. If we have one, it'll be shallow. And I am cutting my S&P 500 price target for year end again to 6,000. But let's hope cooler heads prevail. And I expect a better second half once we have more certainty with these tariff negotiations and more hard economic data come out. Right now, we're having a lot of soft economic data saying there's a lot of fear and uncertainty. But once we have more hard economic data reports and more certainty with these tariffs, hopefully that'll provide more clarity and the market could go higher the second half of the year.